Chris Whalen, Chairman of Whalen Global Advisors, author of the Institutional Risk Analyst blog, author of multiple books, a friend of this show, the very best independent analyst that you will find on Wall Street. And I am pleased to share with this audience the newest contributor to the Julia La Roche Show. You all love when Chris is on every single month. Well, going forward, Chris is going to be on every single week. We will be recording on Fridays and releasing the wrap with Chris Whalen every Saturday. So I could not be more thrilled. Chris, great to see you as always. Really appreciate you. And I'm really looking forward to this collaboration.
Yeah, I am too, Julia. It'll be fun. We can try and tell people what happened every week.
Exactly. Well, this has been a crazy week, and it's been a crazy week in markets, from seeing fresh highs to the biggest declines since April, a lot happening. So I just kind of want to start, Chris. We are recording on Friday, just after the open here, just to give folks the timing of when this is taking place. But let's get your reaction to what we have seen in markets. What do you make of what's been transpiring this week?
Well, first, I think people are taking profits after a very heady year. You know, as we talked about last week, sometimes you run out of buyers. And this is particularly the case when prices move higher and higher. People naturally take profits. One of the interesting things is that we haven't seen volatility in terms of measurements like the VIX and other indicators jump because people are taking the cash off. In other words, they're not hedging downside risks. They're simply going to the sidelines. I do think we'll see more volatility going forward. But we also have an interesting interplay between the Fed and the Treasury that we need to discuss, because I think that may be setting us up for another period of money market volatility, similar to what we saw in 2018.
You mentioned this interplay between the Fed and the Treasury. Talk to me about that, because, walk me through what's been going on there.
Well, the Treasury has to raise a lot of money. They are funding a good bit of spending with debt, so they issue new T-bills. When they do that, obviously investors come out and they buy the T-bills. That means that cash is moving out of their bank accounts and it's going into the account that's maintained at the Fed for the Treasury, called the Treasury General Account.
The TGA,
the back and forth between these two reserves of cash, if you will, is very important to understanding the markets. We've already seen in the last few weeks a situation where the markets clearly didn't have enough cash. They had to go to the Fed. The Fed created a new facility called the Standing Repo Facility, which is a way for the Fed to put some of that cash back into the market. We've even had people suggest that they should take the cash out of the TGA and put it into the repo markets to try and balance all of this off. The trouble is that the Fed's tools for judging how much reserves are out there and whether they're adequate or not are really not well suited to the task. One of the problems, of course, is that these markets are not continuous. They're not efficient. You can have a pile of reserves sitting in a bank, but the bank may not offer them out to the market for borrowing. So that kind of means that the Fed doesn't know where the ground is when they're trying to land the airplane. And that, to me, is a big concern.
And that's like, we have nearly $1 trillion that's been in the TGA. And
yes,
that also has to do with the shutdown that we've seen that's now over.
Partly, yes. They're going to spend that cash faster. They're going to have to pay people that they didn't pay in October. That's already going on now. You saw that with SNAP, with the whole food stamps issue, the U.S. government employees, the air traffic controllers, everybody's got to be paid. So the cash is going to move out of the Treasury. They're going to have to replenish it later this month and going into December. So the volatility of that movement of money in and out is a big deal. You often see market volatility around the quarterly tax payment dates, which are also very important for this. Corporate cash comes out of the bank, it goes into the Treasury account, and then they spend it. So, the government is so big now, Julia, that they are the dominant factor in the money markets. And this is something that I think a lot of analysts, a lot of economists still don't appreciate. It's a balance sheet issue instead of talking about whether the Fed has a new target for Fed funds. I think the balance sheet is more important.
That's an interesting concept, too, that this is more important than, I guess, their Fed funds, like where they see the rate decisions, if you will. Can you elaborate a bit more on that? Because that's like that would be like a different paradigm.
It is. And, the Fed historically has used guidance to try and signal to the markets when they're going to change policy. So historically, if the Fed chairman got up at the press conference and said it's likely we're going to cut the rate for Fed funds next month, the markets would essentially react immediately, and they would factor that into their equation. Today, though, I think there's so much pressure on markets. You have a sell-off again today in the equity markets. You also have a lot going on in other markets like bonds and housing, where I'm not sure that verbal guidance from the Fed is going to continue to have the impact that they want and expect. So in other words, they may jawbone the fact that there's going to be further rate cuts later this year, next year, but the markets may not react the way they want to.
Interesting. Okay, just speaking of like the market reaction, because yesterday it was basically the chance of a quarter point rate cut next month from the Fed at the FOMC. It's now pretty much a 50-50 toss up, and it's down from like a month ago. It was almost a certainty, or most folks were expecting one. Now it's a toss up. Is that also what's been driving like the activity we've seen in markets? It seems like the markets aren't happy that that's not going to be a given.
No, I think it is. If you're running a hedge fund right now, Julia, and you're trying to run a basis trade in treasury bonds, which is essentially how the market functions, you almost have an assumption that says, yeah, they're going to cut rates in December. But we've seen Neil Kashkari, we've seen some other members of the committee essentially get up on the fence and say, I'm not sure. I'm not sure we're going to actually vote for it. And I had worried about this even last month. I didn't know that they had a majority to really cut rates again, simply because, as Chairman Powell said at the last press conference, I have two mandates. I can't do both. So he's worried about inflation still. The target's probably 3% now instead of 2%. And on the other hand, they're worried about parts of the economy. But this economy is still bubbling along pretty robustly.
Okay, so the economy's still going robustly then. Do you see a justification for cuts? Because like so many people, they obviously want them, but we haven't seen like that much economic data either. But what's your assessment of the economy?
I think the markets are functioning. The trouble is that the equity markets are the de facto benchmark for politicians and also Fed governors. So if we see a big sell-off in stocks, I think they're going to probably start buying bonds again for the Fed's account, what we call quantitative easing. Mm-hmm. And, they were planning on stopping the runoff of the balance sheet in December. If they're forced to actually come to the rescue of the markets and start buying bonds, then that's going to signal to people that they didn't quite get it right. And that will make people more fearful and uncertain.
But they probably won't even call it QE. It'll be like,
no, we'll come up with another name. It's such a shame we don't have George Orwell to help us with these things.
Oh my gosh. Okay, but that will be the thing to look for if they start buying bonds, that will signal that they didn't get it right. What do you think they haven't gotten right?
They'll buy T-bills mostly. The Fed
so at the short end,
wants to mirror the Treasury portfolio. If you think of all the Treasury bonds out there, the Fed wants the duration of their account to look like that. So they're mostly going to buy T-bills. They'll run off quickly, unlike when they were buying mortgage securities that have 15-year average lives now. And they will continue to let their mortgage portfolio run off, which I think is a net good thing. But to me, Julia, the real issue is that there are a lot of things going on in the markets today that the Fed can't control. The Fed funds market is barely extant right now. It's almost completely been abandoned by people in the marketplace. The repo market for mortgages, for treasury bonds is, $6-7 trillion. That's where the action is. And frankly, for your viewers, if you want to really understand policy, look at the 2-year treasury note. That to me is the most important maturity out there if you want to understand what's happening with rates. So you compare the 2-year yield to the 10s. And that is, I think, one of the most important indicators out there.
Okay, look at the 2-year versus the 10s. All right.
Yep, 2s to 10s.
All right, 2s and the 10s. Good to know. All right, you put out a piece this morning in the Institutional Risk Analyst, in the Institutional Risk Analyst, IRA.
Yeah.
And the latest piece asks this question: is it November 2018 all over again. So question for you, Chris, is what specific similarities concern you the most between now and what we saw in late 2018? And maybe what's different this time? What is it about that?
In 2018, Chairman Powell had barely been in the chairman's chair for a year. The Fed was shrinking their balance sheet, and they were also raising rates. So those two factors came together, and the market seized up. There was not enough cash in the money markets, in the repo markets, particularly for smaller dealers and participants. The big banks kind of folded their arms, especially JP Morgan and Wells Fargo, and they said, well, we're happy. And they wanted to go into the close of the year without putting more money out into the street. So that meant that there was a dearth of liquidity. And we had a problem. The Fed had to completely change policy. Remember in January 2019, they had the meeting with Bernanke and Janet Yellen, who had to come to Powell's rescue by having a press conference with him. That's rather extraordinary. And that's when they started easing. A year before COVID, they started selling futures in the mortgage market and the interest rate market, and they really dramatically eased policy. So they got it wrong. They didn't understand the dynamics in the marketplace. And that's why I think, the indicators they use are basically economic models that were meant ideally for short-term measurements of liquidity. And when you're trying to plan a year ahead, the models that they use are really not effective. So we're kind of flying blind. I think the best thing for them to do, frankly, is to just look at market indicators. They would be much better off to get rid of their GDP model and just look at the way the markets are behaving.
And if they were, what would their decision be? What would they be doing?
I think they would probably ease policy further, another rate cut in December, and be aggressive about adding reserves into the end of the year. You don't want to be stingy in December because, as I said before, a lot of investors are going to take their money off the table and have a happy holiday. They don't see the need to take risk, especially when you have volatile markets like we have right now. It's interesting when you see Bitcoin selling off with stocks, it makes it very clear that crypto is correlated to the stocks. We've seen this several times this year. On the other hand, gold is actually holding up pretty well in the other metals.
Yeah, we should get into that too. But before I go there, I just want to go back to the 2018 comparison. And do you think, are we setting up for another repo crisis? Is there a risk of that happening?
Yes, I think so. Simply because policymakers don't have good tools for understanding if there are pockets in the market that don't have access to cash. Now, the Fed, by creating the standing repo facility, did address this, and it's been successful. But I think it was very interesting that despite the success of using that tool, Chairman Powell and the other members of the Board of Governors who make these decisions, it's not the FOMC, decided to stop shrinking the balance sheet on December 1st. What they were really telling you is that, we're a little bit concerned about liquidity and we're going to stop shrinking. In other words, when they shrink their balance sheet, they're shrinking bank reserves. That's what it comes down to. Everybody who had sold a bond to the Fed and got cash that went into a bank account somewhere, when that piece of paper gets redeemed by the Treasury and they give the Fed their money back, a bank deposit disappears because the Treasury almost immediately has to sell another T-bill to somebody, as we were talking about before with the TGA. It's a complicated kind of triangular relationship, and that's why it's so hard to manage, because the Fed can't tell what individual investors and funds and banks are going to do. They really don't know. And so all of that factors into how much cash is out there that we can borrow this morning.
Yeah. I had a guest on this week, James Lavish, and he made the case that the TGA is one of the most important concepts in macro right now. There was a bit of a debate in the comment section as if it really is, but my recap from that was TGA goes up, bank reserves go down, financial conditions tighten. The TGA goes down, bank reserves go up, financial conditions ease.
Correct. That is correct. But that's why they're talking about making that cash available to the street, because the Fed historically has kind of sequestered that money inside the Federal Reserve. They collateralize it with Treasury bonds, by the way. So they were thinking in kind of old-fashioned economic terms that it was sterilized. No, we can't sterilize it. You have to make sure that that cash is available to the street, because the Treasury is not going to spend it all in a day. And if you've got $1 trillion sitting there out of a money market to $6 or $7 trillion, that's a big chunk of cash. And that's why this is so difficult to manage, Julia.
All right, let's move on to crypto, Bitcoin, because Bitcoin, it fell below 100,000, but it's also dipped. Today I'm looking, it fell below 95,000. So it's definitely been in a rout the last several days here. What do you make of what the pullback that we've seen in Bitcoin? I don't think you're a Bitcoin fan by any stretch, but just curious, like, what is that signaling to you?
I think the trouble with Bitcoin is it doesn't really have a market. There's no longs and shorts that balance off the demand equation. So when you see large participants in the market moving to the sidelines, taking their profits, you can have a lot of price volatility. We were talking last night about using Bitcoin assets or wealth when we do an analysis of a borrower to buy a house. Well, the question is, if you look at the volatility in that particular coin, how much of a haircut do you put on it? If I'm looking at Julia and saying, okay, Julia wants to buy a house, she has $2 million worth of Bitcoin, how much credit do I give her for that between the time I close your mortgage and 3 weeks later when I sell that mortgage to an investor? Because if the Bitcoin goes down, I have to tell the investor, don't I? The underwrite has changed. And it's that quality, that volatility in the price of Bitcoin that I think worries people. Also, I think it's had a great run. You know, it's gone up quite a lot, not as much as gold this year. But if you're sitting there with millions of dollars in profits at coin, there's a temptation to take it and go buy something else. So I think that there's a fundamental structural problem with Bitcoin because it's not really a market. As long as there's a lot of hype behind it, it goes up and up and up. But as soon as you see selling, the bottom falls out.
You would not recommend, like, okay, I do own some Bitcoin. I haven't done anything with it. I don't even have alerts on it because whatever. I don't care. Don't go buy a house and get a mortgage based on my Bitcoin holdings. Is that a bad idea to do that? Like, I don't know.
No, it's a real asset. Go for it. See,
well,
I believe that if you want to play this phenomenon, you're better off owning the stocks of facilitators, somebody like SoFi or Robinhood Markets, because these stocks have actually outperformed Bitcoin. That's what's so interesting. And there are many other examples like that. On the other hand, you have some of the stable coin plays like Circle that have been getting hammered because people look at the business model and they're, not sure how this thing is going to make money long term. So my sense has always been, partly because I'm a member of FINRA, and owning coins is a red flag for the compliance department. I've tended to stay away from it because I'd rather play stocks. Stocks is what I know. And I don't dislike the blockchain. I think there's a lot of interesting applications for it, but you have to separate the two. Blockchain is one thing, the coins are another. So, to me, coins are a speculative phenomenon. They're like electronic beanie babies.
That's why I'm not like emotional about it. I've had it for a while. I don't really care. Gold though, you did mention gold. I know we've talked about gold. You and I have talked about how most investors, most households, they're massively underinvested in gold. They're not, It's not correlated to crypto. I guess why that matters so much, like that correlation not being there.
It doesn't really. I mean, people look for correlations sometimes where they don't really exist. I think Bitcoin is simply a function of how people feel about that market on a day-to-day basis. I would tell you that I couldn't prove one way or another if there's a correlation between it and other asset classes. Gold, on the other hand, as you said, the dearth of allocation on the part of U.S. investors, the limited supply, and the fact that global central banks have now decided that gold is the chief reserve asset in the world. Those are the three kind of big arguments in favor of having exposure to gold going forward. And it's not something you're looking at, for a turn in the next month or two, but it's something that I am long gold in a variety of ways. I'm long some of the miners. In our newsletter, we've been starting to do interviews with some of the more interesting miners, not just in gold, but in other metals like nickel and copper, because I think all of these asset classes, these tangible assets, are going to benefit in the next few years. It's just, there's demand. Nickel, for example, is how we make stainless steel. It's how we make alloys for all sorts of applications. And there's not enough of it. Countries also want to get China out of their supply chain. So this is going to put a lot of pressure on the US, Canada, other nations to create new supplies. And that's what they're going to do. It takes time. Putting together a new mine for copper or nickel or anything like that takes years.
Yeah. I guess a lot of people, Chris, one of the arguments for Bitcoin was that it was going to be the fiat replacement. But I feel like more and more people are gravitating toward gold. Yeah. And the central banks
that's
too.
Right. The opus of Satoshi said that Bitcoin would be a replacement for fiat currencies. The trouble is that it became a speculative vehicle in terms of price change. On the other hand, if you look at a stable coin, say that's issued by a large, retailer like Amazon or Walmart, right? You have a high degree of security that says, yes, this is going to be worth $1 tomorrow. And you're starting to see people put coins out that have an explicit yield, which, by the way, is a security. As soon as you have a stated yield on a coin, you have to go to the SEC and get their blessing. So it's going to evolve over time, but I still think, to me, stable coins are really prepaid gift cards. And if you're dealing with a big vendor like Amazon and they say, well, if you buy my stable coin, I'll give you a 3% discount on everything you buy on Amazon. That works because they have an incentive to take the costs, internalize the cost, and give you the benefit in terms of the discount. But for individuals, do I want my own stable coin for the readers of the Institutional Risk Analyst? No, the cost is too high. And plus, they're going to get the return on my fiat. The Genius Act says that they have to invest those proceeds in high quality liquid assets like a bank and at a bank in the trust department so that there's a backing for the coin. So to me, is that a great deal as an investment? Nah, I'd rather have Bitcoin. At least it goes up in price sometimes.
Let me see if I can squeeze in a couple more areas that I want to cover with you this week. Private credit. It seems like more and more issues with private credit keep bubbling up. I guess my question for you is, how big of a concern should this be? Like, is there a risk of contagion here? What do you make of what's happening in private credit? What are you hearing in your own conversations?
Well, we just saw an example of a home builder that was financed by BlackRock and some other private equity funds.
Yeah, was that Renovo? Renovo. Yeah.
Yeah, it's so unfortunate. They're going to basically take a total loss. It filed bankruptcy. The customers, the vendors of that company will probably take a total loss. And they had been doing what's called payment in kind. They didn't have the cash to pay the debt, so they were giving everybody more equity. But there's a finite limit to how long you can do that. And eventually the investors had to admit that this thing was not worth 100 cents on the dollar, and they've had to write the whole thing down. You're going to see more of that, Julia.
Okay, so we'll watch that space. The government shut down. The government reopened this week, but it seems like I don't know how you feel, but I always feel like, do we really even address the problem or the root cause? I feel like we're going to see this happen again and again. That's maybe the skeptic in me, but maybe your thoughts on the shutdown resolution this week and I guess your expectations going forward.
It's going to be good until early January. The Democrats are desperately trying to get traction politically. President Trump has, sucked all the air out of the room since he took office. So I think you're going to see more combat. But, it's unfortunate. Chuck Schumer, the Senate Democratic leader, is probably going to lose his leadership post at some point. He may end up retiring. He's going to be done, I think, in 2029. The more radical elements in the Democratic Party, if they take over leadership in the Senate, I think the Democrats are done. I really do. I think you're going to see a lot of Democrats around the country who are more moderate in terms of their agenda uh, have to either create a new party or become Republicans. And you saw that with the Democrats who crossed the line and supported the Republicans without having a vote on the subsidies for Obamacare. It would be nice if we could have a conversation to fix healthcare. There was a wonderful interview on CNBC this week with the former chairman of Verizon, who's also on the board of one of the big insurance companies. And he laid out a very interesting agenda for how you fix this. But unfortunately, the political parties in Washington are not able to sit down and have a conversation like that because it's all about the midterm election. They would rather sit there and throw stones at one another instead of getting anything done. So I think unless we see the Republicans really get a majority in both houses, you're not going to be able to make progress on a lot of these issues.
Wait, was that Mark Bertolini?
Yes.
And I'm a huge fan of his. I've interviewed him many times over the years. I should have him on the show. And I've read his book. He's got a great backstory and a great book, and just a really good human.
Impressive guy. He's obviously done the work. Yeah,
really, really cool person. You know what? I'm going to put that on the list. I'm going to have to do an in-person with him in New York. So Mark, if you're watching, I will be reaching out. Okay, Chris, one of the areas I cannot let you go if I don't talk to you about mortgage markets, housing policy, the conversation that's taking place. I think you were at a conference this week. What are like the top topics right now in that world that you operate in?
Well, the mortgage market had rallied pretty strongly. We were just below 6% on 30-year fix around Halloween, but it's backed up about a quarter of a point, even though the Treasury market's been rallying. So the yield on the 10-year is going down and coupon rates for mortgages are going up. Partly this is uncertainty about the Fed, when they're going to cut, but it's also uncertainty about how the yield curve overall is going to perform if the Fed cuts rates. So if they start buying T-bills, it's going to force the short end of the curve down, but we price mortgages against the 10-year Treasury. Short-term interest rates don't help us. It helps in terms of financing your business, because that's how we price, warehouse lines, for example, the way we finance your mortgage before we close it. But, to price mortgages and sell them to investors, that's the long-term Treasury market. And we're not sure. This goes back to the whole issue of the Treasury market, the basis trade, and how investors have been playing this over this year. We're not sure how the yield curve is going to perform going forward. So in August, you saw a lot of lenders getting very aggressive. They were pushing coupon rates down, even though the market wasn't quite there yet. And then they had to pull back. So again, in September, going in October, you saw a lot of aggressive moves by lenders because lenders set coupons. The markets don't set the coupon on your mortgage. They have to decide what they're going to offer you, right? Then they have to sell that mortgage to an investor. So there's a two-step there. Now, people are a little uncertain. And I think going into the year, we could see, 30-year mortgage rates stay well above 6. And that's going to cool down the party. It's still going to be a good quarter. I think fourth quarter is going to be good for lenders. But a lot of consumers who are very smart and are very adept at this, they're waiting. They want to see rates go down into the 5s. And that's when you're going to see more volume. The home builders, everybody else is going to be happier.
The little boomlet. Chris, it's been so fun having you on the show on a monthly basis. I'm so happy to have you on a weekly basis. I just love our conversations. I love listening to you. I love learning from you. Before I let you go, a couple of things. Let folks know where they can find and support your work and subscribe to the Institutional Risk Analyst, pick up books that you've written, and what they should be thinking about as we head into next week. What are you going to be paying attention to next week? The floor is all yours.
Well, we publish the Institutional Risk Analyst. We're going to be putting our talking points out every Friday before we have the conversation with Julia, which is going to force me to focus on what's important, which is always good. I'm worried about government debt and the Treasury market. That's really the big factor that overhangs just about everything we talk about. I do think you're going to see a correction in equities simply because we had such an amazing year. Give you an example. SoFi is the best performing bank in the country. They gave back all of their gains over the last 30 days, but the stock is still up 85%. Citi was number 2, by the way, among banks. Jane Fraser has done great work getting that bank into better shape. So, again, up 50% in the last year, but it's given ground. So I think a lot of these stocks have done extremely well in 2025. 26 may be a different story. So we'll have to see how that pans out. But we're going to talk about it every week.
Yes, we will. Chris Whalen, Chairman of Whalen Global Advisors, author of the Institutional Risk Analyst. Thank you so much for being so generous with your time, all of your knowledge and your wisdom, helping us all learn and get better. And thank you for being a contributor to this show. Really looking forward to more of these, more of these weekly episodes of The Wrap with Chris Whalen. Thanks so much.
Thank you. Have a great weekend.
Likewise.